Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity. In this episode, my partner and the CIO of Mutinyfund, Jason Buck, speaks with three of the most experienced volatility traders alive today: Jerry Haworth of 36 South, Bastian Bolesta of Deepfield Capital, and Chris Cole of Artemis Capital. This was originally recorded in July of 2020 for the financial media channel Real Vision, but contains timeless wisdom that lies deep at the heart of investing in volatility. I hope you enjoy this episode as much as I did.
Welcome everybody to Ahead the Curve. I'm Jason Buck from the Mutinyfund, and it's my distinct pleasure to sit down with Jerry Haworth from 36 South, who has over 3 decades experience trading the markets. I guess I'll start with Jerry. How's the weather in the south of France today?
It's absolutely stunning. Thanks, Jason.
Not a bad place to be, and obviously you're coming off a monstrous year, given what's transpired in the markets. I think the best place to start to give us an overall framework for this conversation is something that you and I both are fans of with ergodicity or ergodicity economics. Now, ergodicity is a complex word and a complex subject or philosophy, but I think maybe the best way to describe things often is with metaphors or analogies. And I've heard you use Bernoulli's shipping insurance or for cargo ships before, and I was wondering if you could tell that story or expand on that subject.
Yeah, so I think it was 1780 something that David Bernoulli elucidated this theory that as valid today, I believe, as it was then. And basically, he gave a shipping analogy of moving goods from Amsterdam to St. Petersburg in Russia, and whether you should insure it or not. He did make the point that if you put all your life savings on one ship and take it and put it on the ship bound for St. Petersburg, as opposed to putting it on 100 different ships, your risk is totally different. Now, markets basically and all the theories that are bound today basically says that by default you've got 100 ships, but it's not strictly true. We live only one life. We're on one ship. And our retirement nest egg, basically, we try to carry that through to the end. And we don't have multiple pathways or multiple ships in which to put it on. We have one. And so our risk profile actually is markedly different. Why would you add volatility into a portfolio? There's 3 basic reasons. Because you're investing with someone who's got an edge and they're going to make money for you, or as a diversifier, or as a tail hedge. And I think, there's many vol funds in the world, and a lot of people buy a diversifier thinking they've got a tail, or they buy, they sell options thinking they covered, only to find that implied volatility goes mad and they end up losing money. So the reason why people go to the vol fund effectively is because there's a strong negative correlation to traditional equity markets. It's very rare. They're very rare animals to find something that has the following characteristics: has a negative correlation to the traditional equity markets. It has a symmetry of outcome, i.e. you don't have to put down $1 to make $1. You can put down $1 to make $10. It has convexity, which matches the consequences of what happens when the market goes down 10, 20, 30, 40, 50. The consequences are exponential. And so when you've got convexity, you've got exponential return. And these characteristics make it the reason why everyone should have a bit of it in their portfolio. They just, if it happened to be blackberries or blueberries, we'd be in the blackberry and blueberry market. But it just happened that volatility has these, I think, very, very useful characteristics for any traditional asset market.
What I really like, and I think find it fascinating about 36 South, is you guys take a very different approach to long volatility or tail risks, in that you look at much longer dated options. You guys buy 5 to 10 year leaps as have an average duration like 7.5 years, and you look at maybe rolling those on maybe an annual basis. Can you kind of talk a little bit more about how you look at that with buying leaps and why you buy leaps and the markets you look at to buy those leaps?
I mean, I've always been interested in options. I did my thesis on the viability of an options exchange. From the moment I heard the word quite a few years ago now, that I knew that that's what I'd be interested in. Volatility, what drew us to volatility is effectively opportunity. We realized in about late 99, 2000 that long-dated options, there's definitely an edge for people that can have a longer time frame in which to operate. There's definitely an edge available to people who access that. Volatility by nature is cyclical and mean reverting. It goes from a low vol regime to a high vol regime, back to a low vol regime. And if you manage to warehouse longer dated options when you're in a low vol regime, i.e. the price is cheap and the odds are very favorable, they're in your favor, and you give yourself enough time to be right, then the odds should play out much. It's like having, and we go pan-asset class as well, which goes straight into the analogy of 100 ships. We try not to put it all on one option. We have a pan-asset portfolio of long-dated options, and we patient. We just we wait to be right. And what drew us to volatility was the fact that we could get an edge. And it was only after 2008 that we realized that the volatility market, the volatility space has some very unique characteristics that are very interesting to traditional portfolio managers. So that's when we put an emphasis on crisis protection as well.
Great. And so I want to come back to using pan asset classes. But one of the things you usually hear the trope that, all options expire worthless. And that's true if they're held to expiration. But I think that you guys even buy longer dated, but you're rolling much more frequently. And when you do that, is it a way of basically creating almost like a perpetual option, or almost your own synthetic CDS contract? So if we've had 12 years that go on without a big, risk off event, that doesn't really bother you because you're just constantly rolling these options. And how do you think about the cost of rolling those options or maintaining that position for 10 to 12 years at a time?
Well, we believe using the metrics that we've designed over better part of 20 years, that we believe we have negative carry in which we pay out every year, but we have positive expected return. So the best analogy I could do is the casino where the croupiers offer the odds, and they have a very short-term memory. So if 17 comes up 3 times in a row, they will offer you odds of 5-1 for the next 1,000 spins. That's clearly a bad bet if the real odds are 37, 38-1. But by the same token, if 17 hasn't come up for 6 months, they might offer you 100-1 for the next 1,000 spins. Now, that's clearly, and my definition of an investment is where the odds are in your favor. So I give the gambling analogy or casino analogy. I still consider for the casino, it's an investment because the odds are in his favor. For the punters, it's a gamble. So we can invest in these options. Clearly, there are times where even though the odds in your favor, it doesn't happen. But if you get enough of them, the law of large numbers, and you wait long enough, the law of large numbers pans out.
What I really like about what you guys do with, like you said, pan asset classes and putting on maybe hundreds of these, leap options bets across all market classes is that there's 2 ways to look at volatility that you referenced before. There's like before a volatility event when we're in a low volatility regime, and then there's post event when we're then maybe in a high volatility regime. what's interesting to me about the pan asset classes is that you're not necessarily tail hedging as much as tail seeking when we're in a low vol environment. So if you have a pop in volatility in a currency play or a commodity play or in interest rates, you can monetize that, and that helps with that carry over the risk on cycle. So you're getting little pops here and there that reduces that carry. And if you want to talk about that, I find that very interesting.
What we observed and what we believe is that in a systemic crisis, asset class volatility that tends to correlate to one. So the currencies get volatile, the equities get volatile, the bonds get volatile, commodities get volatile. And there are massive disparities across asset classes in terms of how much you pay for an option. You know, you can access probably right now a 10-year Japanese put for strike 108, which is slightly out of the money from the forward, for 3% premium. Now that buys you nothing in the equity market. Now, if we write in our thesis that if a crisis is systemic enough, we need to see orders of magnitude lower movement in either the implied volatility or Japanese yen direction in order to get much better multiples than like what's available in the equity market at the moment. So, and you never know where the crisis is going to emerge. I mean, black swans, it could be an Asian crisis like in 1997. It could be a bond crisis. It could be an equity crisis, all of which will affect your portfolio.
Exactly. That's what we love is like, you never know what that path dependency of that risk off is going to be. That's why you need to cover as many as you can as possible. And you do that by buying cheap convexity. So we talked about how pan asset classes help, prior to an event. And then as you reference in the event, the correlations go to 1. So you get all of these payouts flowing at the same time, because when we move from low vol to high vol, it's that movement is usually so violent. That's why those correlations go to 1. But then you're looking to monetize. So
and that's another benefit of long volatility, because the nature of option volatility or pricing is so counterintuitive. Everybody wants to sell when they're cheap, and everyone wants to buy when they're expensive. It's natural, but it's counterintuitive. And so we buying when everyone wants to sell, and we have liquidity in a crisis when everyone wants to buy.
Yeah, exactly. We're when nobody wants to buy, guns, butter, and water, we're just building up inventories and waiting till those things are priced dear. So yeah, it's kind of like you said, it's very counterintuitive. So one thing I think that a common misconception when people talk about long volatility or tail risks, people just assume that you're hedging the left tail, but you don't you buy right tails. Why buy right tails?
Yeah. Firstly, there's as many opportunities on the right tail as on the left tail. So if markets run towards the right tail, we use those profits to help fund the left tail, because you can get out of touch with the left tail pretty quickly if the markets do a run up like we've seen in the last 3 months. So there's that. And I'm also a big believer in the right tail in terms of inflation. I was born and raised in Zimbabwe. I've seen hyperinflation. I think it's a valid tail risk, because certainly hyperinflation reduces everyone's wealth, and there's very little you can do about it.
And then the other thing we think about, like we talk about a lot domestically here in America, is the Canadian pension plans or Australian superannuation funds. They're selling a lot of volatility. And what we think about a lot is the dealers that take out their side of the trade, they have to gamma hedge those positions, which, tends to suppress volatility if it's in a tighter range. But as soon as we break out to the outside, that rubber band snaps and exacerbates the sell-offs. And to me, the same thing happens in those agent structured products with the investment banks that's hedging out that risk. Is it, once again, it's an accelerant as you move towards those strikes.
Yeah, the market doesn't change. The names change, but the cycle is effectively the same. I've seen quite a few cycles. It's much the same kind of thing. And I believe call overwriting your existing portfolio is a valid strategy. If volatility is high and you're getting paid the right premium, like right now, I think call overwriting equity and bond portfolio is not necessarily a bad thing. But to write naked risk when you're already overweight equity, I don't think it's prudent.
And that's my favorite part about your pan asset approach is even if the bulk of your portfolio is in U.S. domestic equity beta, after an event, you need to look at other asset classes. You need to take some basis risk because that convexity and that volatility is going to manifest somewhere, and it may no longer be in the actual equity indices.
Yeah, and it doesn't matter if you got a retirement fund and the S&P goes to 10,000. It depends what that 10,000 buys in 10 years' time. If the dollar has gone down 90%, it's going to buy a lot less than you had today. So you got to always look at both sides.
Exactly. And then I always love all your analogies and metaphors. And now I was just thinking about one I've heard you use before, and it reminded me so much of what we've gone through, unless you feel it's differently, is you talked about volatility is frequently like a train leaving the station. And you get that first jolt, as we all feel, and then it quiets back down, and it just slowly accelerates as it leaves that station and it heads on its journey. Do you feel like that's what we've seen, or do you feel maybe this time's a little bit different, or do you have a different analogy or metaphor for it?
I would like to believe it to be true because obviously it suits my book. But there's so much distortion created in the financial markets now by central bank intervention. I wonder if the analogy would hold. In a normal market, I think that would be true, but I'm not 100% sure now. But I go back, I certainly think, and currency options haven't even left the station yet. They haven't even had their first jolt yet. And I do believe it'll be difficult for central control currency volatility once it breaks its localized bands.
But I guess the good news is, we obviously we're talking our own books. We would hope that would be the event that happens, is that the train's left the station. But at the other point in time, it doesn't matter. It doesn't matter if that's our view that happened, because we were able to load back up on these pan asset class options, right? It doesn't matter as vols drifted back down into the 20s. We're just loading back up in inventory, and we don't know if the event's going to be tomorrow or 10 years from now.
Exactly right. Exactly right.
Well, I can't tell you how much it's been a pleasure to pick your brain, and I appreciate you sitting down and having the time to talk with the Real Vision audience. And thank you so much. And I look forward to having continuing conversations in the future.
It's been an absolute pleasure. Thanks, Jason.
And today it's my pleasure to sit down with Chris Cole from Artemis Capital and talk about all things long volatility. Looks like it's a beautiful day in there in Austin. Chris, how's it treating you?
It's beautiful, but a little hot. So this time of year in Austin, Texas can be a little trying, but sunny as always, though.
Great. I was going to start with an easy question, but it actually might be a very difficult question to answer. You have popularized the idea of long volatility. I think that your white papers and everything have brought the idea into the zeitgeist of what long volatility is and why people should have it in their portfolios. But just a simple idea is, what do you think long volatility is? How do you define long volatility? What kind of philosophy do you think long volatility entails?
Volatility in markets, being long volatility in markets is one thing. Being long volatility in life follows that, and they're very similar. It simply means making change work to your benefit. And usually that involves paying maybe some sort of small upfront cost to transform any type of extreme change in whatever direction to work in your favor. Obviously in markets, when you're long volatility, you're long an option, and you could profit from an extreme movement to the right or the left tail. And you usually pay something in order to have that exposure, and the profit is nonlinear. In life, when you're long volatility, you pay some upfront cost. That could be maybe meditating 20 minutes a day. It could be working out. It could be putting yourself out there to make new relationships. And that makes you benefit from change and be able to handle the changes of life and to transform those to be a positive rather than a negative to you.
Fantastic. So we've been exploring the idea of why add long volatility to your portfolio. And I love a good metaphor. So I love when you talk about Dennis Rodman. So you and I coincidentally happened to grow up in Michigan around the exact same time. So we got to experience in formative years the original Bad Boys Detroit Pistons, Dennis Rodman. But I think, across the globe, due to this new documentary, The Last Dance, people have gotten more exposure to Dennis Rodman. So talk to me how you think about Dennis Rodman as long volatility.
Well, I love this metaphor. Most people, obviously, Dennis Rodman is a colorful personality, but he's also a member of 5 championship teams. And there was a tremendous piece of work that was done, statistical analysis, that actually came out and said that Dennis Rodman was one of the 20 best players to ever play the game of basketball. And that analysis was backed by a substantial amount of advanced statistics. Well, Rodman is the lowest scoring inductee in the Basketball Hall of Fame. The highest scoring he ever did in a season was 11 points. He was not a threat to score, as you know. Really, outside of dunking the basketball, he was not really a threat to score outside of 5 feet. But despite that fact, something really bizarre happened when Rodman was on the floor. When you put Rodman on the floor, the offensive efficiency of his teams went through the roof. His wins over replacement value were among the highest in NBA history. You could put Rodman on a mediocre offensive team, and it would turn that mediocre offensive team into a very, very good offensive team. If you put him on a team with Michael Jordan and Scottie Pippen, 2 of the best players to ever play the game of basketball, all of a sudden a really good team becomes the all-time best team ever. Why is that? What did Rodman bring to the table? Well, Rodman couldn't score the basketball, but he was good at one thing, and really good at that one thing, which was rebounding the basketball. When somebody missed a shot, he would go grab the rebound. He averaged close to 18, 20 points or 20 rebounds a game at his prime. Well, this gets very interesting because at the end of the day, when you look at that, if you're grabbing 10 offensive rebounds a game, that converts into, an extra 10 shots at a 50% efficiency. You're getting an extra, a good extra 10 points a game. So you give Michael Jordan an opportunity to have a second or third shot, and Michael Jordan's not going to miss that. Scottie Pippen's not going to miss that. So Rodman, when you put him on these teams, increased the offensive efficiency of his teams, and he transformed teams into great teams. And he was unique in this fact. But people don't consider Rodman this great player because, first of all, a team of Dennis Rodmans is not going to work. You need to pair Rodman with other scorers. And people overlooked these other defensive contributions that Rodman did because he didn't score much. Dennis Rodman is a lot like long volatility in the portfolio. Long volatility is an asset class that tends to be anti-correlated, and it tends to do best when there's a lack of liquidity, when stocks are crashing, when bonds are malfunctioning, when there's terrible credit drawdowns. And long volatility, when the rest of the world is sucking liquidity out of the system, long volatility is giving you liquidity. When you need that extra shot in the fourth quarter, long volatility is rebounding the basketball and giving you a chance to take a second and third shot at these other asset classes like stocks, bonds, real estate, credit. So very similar to Rodman, if you put long volatility in an institutional portfolio, it greatly amplifies the other asset classes. And this is not an opinion. I published a paper earlier this year, came out in January. I looked at 100 years of testing in various portfolio strategies and determined that a portfolio that had what I call the dragon portfolio, that has substantial positive exposure to left and right wing tail volatility, putting the long ball in that portfolio at a clip at a shocking percentage of about 20% is a major constituent of that portfolio. And that portfolio has beaten almost every other portfolio that you can imagine, from 60-40 stock bonds to risk parity portfolios. And I wrote that in January. And sure enough, that portfolio this year is substantially beating all other peers, both during the period of the March drawdown and also the recovery. People underestimate defense. They underestimate non-correlation or anti-correlation. And they underestimate liquidity, the value of liquidity, and investments that give you liquidity versus investments that take away liquidity. Institutions love to go find a manager with a very good-looking trailing Sharpe ratio that is anti-fragile to change. And they underestimate the impact of volatility and the need for volatility. And this is why long volatility remains this small niche when it actually should be a dominant part of the institutional portfolio. And once again, this is not an opinion. You can go back and look at some of the research, Allegory of the Hawk and Serpent. Over the years, I've written many research papers over the years, and these arguments are presented using math over and over and over again. And there's just no other way to look at it.
And it just so happens serendipitously that there's 5 players on a basketball court, and it just so happens your Dragon portfolio has 5 categories of assets. Can you describe the other 5 and then discuss which ones are short vol and which ones are long vol and why that combination?
Absolutely. So if you look at the concept of the Dragon portfolio, there's 5 different asset classes, and the first 2 are pretty basic. That could be stocks and bonds, standard. You could substitute real estate or private equity in there. I would say stocks would be equity-linked investments, business cycle-linked investments. The other asset classes would include long volatility, which plays off of both left and right tail. That's an investment strategy that profits in secular change. Another investment would be gold. That is a right tail investment that profits from periods of secular change. And the last one would be trend following commodities, which also profit from periods of secular change. Asset class like bonds and credit stocks tend to do pretty well during periods of secular stability. That would really be the last 40 years of since the 1970s to today. The other investments do very well during periods of secular change. This includes periods of intense deflation or periods of intense stagflation, or in the worst case, hyperinflation. So people tend to think about left tail as the markets crashing. We see that the Great Depression, what we experienced in March, what we experienced in 2008. Obviously, people think about volatility in that context. That's one element of that. But people don't understand that there's also this right tail where you can have incredible volatility with rising asset prices. We've seen a little bit of that recently. We saw that in the late 90s. We saw that with the stagflation in the 1970s. And you also see it in eras like the hyperinflationary eras of the 1920s with Germany, where you have tremendous spot and vol up behavior. We saw a little bit of that in China in 2015 as well. Volatility can do well in that environment. Obviously, gold is something where in a right tail environment where you have fiat devaluation, gold in many ways is like an option. It has convex nonlinear payouts during periods where there is devaluation of fiat. And gold does very, very well during those periods where you either have right tail risk given fiat devaluation, or you have governments looking to devalue fiat in conjunction to combat a deflationary environment. The last is obviously commodity trend, which very similar to gold and very similar to volatility performed in the 1930s and also the 1970s. Commodity trend does very, very well during periods of stagflation. So the 70s were the home run period for commodity trend. If you take all of these asset classes together, overall, you get a portfolio that has performed for over 100 years consistently through every regime cycle. So you're able to consistently make money with between 1/3 to 1/5 the drawdowns experienced with other investment strategies, and you're able to hold these. Not all these asset classes will do well at any point in time. Long volatility has done very, very well this year. But if you looked at its trailing Sharpe ratio over the last 5 years, it was not a very popular investment. Commodity trend hasn't done very well, and it doesn't recently, but did exceptionally well during the stagflation of the 70s. If we had a stagflation come back to the United States, you'd want to be in something like commodity trend. The point is that these investment strategies, like long volatility, they're not really intended for a rainy day. They're intended for a rainy decade. So the idea at the end of the day is that you have to hold a balance of all of these different asset classes, and some of them actively managed, in order to get the benefit of that composite portfolio. I would never recommend somebody put all their money in a long vol fund. They should put their long vol fund to balance out the rest of their investments. And if they had done that this year, March would not have been a problem. No sweat. It's just an opportunity for them. To go back to the right tail concept, I think most people are very focused on left tail, and understandably, but there's a different form of secular decline. And I've talked a lot about this, where there is no way to destroy volatility. It can only be transmuted in time and form. And in my paper, The Allegory of the Hawk and the Serpent, I describe the two forms of volatility transformation. One is the left tail of the hawk, which represents this type of deflationary collapse. But then there's the right tail of the hawk, which represents the reflationary movement, and where fiat is devalued. So this would involve periods like the 1970s, where Nixon depegs us from the gold standard, and there's a massive devaluation of money. It would resemble periods like 1919 to 1923 in Germany, where there's a hyperinflation, where equity vol started at 20% and then topped out at over 2,000% because nominal prices were exploding so much. In each of these cases, whether it's stagflation, hyperinflation, or any type of fiat devaluation or helicopter money type of scenario, stocks go up, but they don't keep pace on a real adjusted basis. The 1970s, on a real adjusted basis, was a depression for stocks. But in actuality, you had about a 30% drawdown, but they were a depression for stocks. But if you were invested in right tail gold, let's look at gold. Gold right now, vol's around 15. For the greater point of several years, it's been as low as 9, 10 vol. Gold volatility in the 1970s went all the way up to 80%. So if you might be invested in equities, but if inflation is running at 10 to 15% a year, your savings are being eroded. Obviously, real assets are doing well, but if you're owning right tail volatility, particularly in the right asset classes, be it gold or stocks, that can provide excess return, particularly if layered on top of equities, to help make up for that loss in a real adjusted income. So volatility is something that plays on both tails, and I think is very, very important. We don't know. We are going to devalue. The world is going to devalue one way or the other. I'm not smart enough to know which way it is. But there's only two routes. You default on the debt or you default on fiat. And this is going to be the reality that we encompass over the next decade. If a vol manager focuses on only one tail, they may miss the devaluation of fiat scenario. And so now we're in a market, we've gone from this deflationary collapse to a market that resembles the worst speculative melt-ups in history. And from in my world, as a vol practitioner, that really means three things. You have spot up and vol up. So you have these environments where both where the movement of the underlying becomes correlated with vol. Most people think about the VIX going down with the market going up, and the VIX going higher with the market going down. But the VIX is agnostic to price direction. It only cares about the movement of the underlying. So when you start to see these daily 1%, daily 2% moves higher in the S&P, this drives this dynamic of higher vol, spot up, and vol up, and we've seen that in China in 2015. We saw it in Japan at the onset of Abenomics and the blowout of many of those Uridashi structured notes. We've seen it in 1999 with the dot-com bubble. It's been prevalent in almost every major speculative bubble. From an option standpoint, the other thing that is particularly prevalent is substantial right tail skew in options prices. And this is pronounced in the most popular names. The FANG stocks, are perfect examples of this. And many of these popular stocks, be it Tesla, be it Apple, are trading over 90th percentile of measuring call implied volatility versus at-the-money volatility. It's what I call right tail skew. What that means is that you have a lot of speculative investors putting a ton of, making a lot of speculative leverage bets on the right tail of the distribution. We saw a lot of that in 1999. There were entire con men who sold programs to investors on how to bet on right tail options during that period of time. And we're seeing that now again. The names are different. The retail investor access is different. It's not Yahoo message boards anymore. It's Twitter, and it's not E-Trade. It's Robinhood. And it's not a bunch of boomers, but it's a bunch of millennials. But it's the same pattern generation after generation, and it echoes the framework in the vol market as well. So I think these are very, very interesting phenomenons, and that are hallmarks of right tail euphoria.
I think about, there's a lot of this like prohibitive nomenclature we have in the option space, and certain words can mean many things. So I think about, when you're talking about right tail skew and the overbuying of calls, I always also wonder at the same time is like when trades become inherently right skew and the overbuying of calls, and then you put that trade on, are you now on a left skew P&L, meaning you're predominantly going to only see risk go to the downside, or how do you think about that?
Well, I think that's what's interesting about that is that, right tail skew, it means that people, at least in many ways, it's better than putting a levered bet in the underlying, because at least you have a known loss profile. But what that is indicative of to me is that you have a lot of new investors coming into a market using options to access leverage who are not even looking at the implied volatility. And they're using options not in a sophisticated way, but in a way that's really speculative to gain access to leverage in a way that they can't gain through they don't have the capital, and they're doing it in a way that is not necessarily informed. And it's very telling, and it's something that you see time and time again. I look at that right tail skew and I see something that is you can graph the names and the situations change, but the numbers look the same as they did in the 90s.
So just going back to touch on the retail traders, obviously you need to pay attention where all those flows are coming in from and everything. But I think it's like, there's nothing as, certain in life that the old are going to disparage the young, right? And I think about how dumb maybe I was as a youth, right? And we came up probably betting on the first .com bubble, right? And we all thought we were geniuses. So I actually look at the retail traders as like, I think it's great. You lose money on calls on FanMag stocks or whatever, but through losing that money, a lot of them are going to dive deeper and go, oh, there's these other dimensions of implied volatility, skew, time horizons. And it's an impetus to learn. So I have a much more, I think, positive outlook than that, because I remember how dumb I was in my youth. Not that I'm any smarter now, but like these things happen, perpetually, like you're saying, over time.
What we've seen traditionally is that there's this kind of unholy trinity between volatility, liquidity, and credit stress. It's an unholy trinity. And if you want to know where vol comes from, it comes from a lack of liquidity and stress in credit markets. And what we seem to continuously do is just flood the system with liquidity. Flood the system with liquidity every single time. But liquidity is not a cure for insolvency. And we're at a point now where it is divulging into, and this goes back to previous quotes, because I think I talked in Real Vision, even way back to the original interview in Real Vision, saying that ultimately the risk is that they keep flooding the system with liquidity, the income disparity becomes so large, and that it becomes a threat to our democracy.
Thinking about the future, and maybe this is kind of a teaser because we might be running over to overtime here, but how do you think about as we move into these different market environments, like you're saying, the dynamic changes, whether it's a more proactive Fed, now that we've had a liquidity shock, maybe you need to move over there into pan asset class, protection with options. What is on the horizon for you guys as far as at Artemis Capital of what are you looking into, what asset classes, what kind of trades are you looking at, as we're sitting here in 2020?
Yeah, that's a great question. Artemis, the very beginning of Artemis came down where I started trading VIX futures and VIX options. That was the basis in the founding of the firm. But over the last couple of years, we have really expanded out across multi-asset class and are looking at diversified vol and looking at finding ways to signal volatility and find flags for volatility using global cross-asset data. So we're scanning the globe, looking at different features that might indicate the probability of volatility breakouts in different asset classes, and then valuing the volatility in those asset classes using the traditional volatility arbitrage techniques that are the crux and basis behind many managers, but actually augmenting those with additional data that goes far beyond. So I see us going from what really was a VIX specialist into a cross-asset momentum macro long ball shop, and doing it in a way that is very capital efficient for our investors. So an investor can use an SMA and actually, in a very capital efficient way, layer our exposure on top using listed options. That gives them the ability to have capital efficiency and convexity at the same time with positive carry.
Well, capital efficiency is my favorite subject. So before we go on another rant, I guess we'll have to revisit this in the near term. But Chris, just want to thank you again for coming on ahead of the curve. I always really enjoy talking to you, and it was a pleasure.
It's been a pleasure to be back on Real Vision, as always.
It's my pleasure, and I'm excited to talk to Bastian Bolesta of Deep Field Capital. Normally, Bastian's headquartered in Switzerland, but he's coming to us today with his family in Corsica. So my first question is, have you been able to stand up paddleboard while you've been in Corsica?
Yes, I did. As we shared during one of our last conversations, that's one of the short times I get without thinking, because maneuvering on the board helps you to clear up your mind because you're just thinking about waves and water. But besides that, I have managed to do so, as you can tell from my lovely 10. Until 1 week ago, I still had my Corona COVID-19 bleach on, and no, I'm doing fine. A lot of work because markets don't keep calm, as all of us know. But thank you for asking. I had 3 days on the water, which was nice. What I really like about what Deep Field Capital does that I find so interesting is you guys take more of a 4-pillared approach to volatility trading. I want to start kind of with the VIX trades, which we call VIX arbitrage, which is more of a statistical arbitrage, or also called a relative value trade. Let's start with maybe an intramarket spread. What is an intramarket spread when trading VIX products? Yeah, that's referring to the second pillar. So these 4 pillars, as you correctly pointed out, are on the vol arb side. The second pillar, the intermarket spread trades, the VIX future front months against the S&P. The idea here is that you have the realized volatility playing out in the S&P. So you can measure how the S&P moves on a daily basis. And at the same time, you have a forward-looking projection of volatility embedded in the futures, which is the implied volatility. And you basically either trade it long or short in order to benefit from what could refer to as a volatility risk premium / roll yield, which is embedded in the VIX futures, and which is not part of the S&P itself. So you basically try to lock in something while hedging yourself, so to say, with the S&P.
So when you're talking about, you said short, or long, and what you're referring to is when the term structure of the VIX is in contango, you're going to go short the VIX and short the S&P based on the anti-correlation of those two trades. Is that how you look at it?
Yeah, exactly. The anti-correlation is quite pronounced in various market environments. One has to be a little bit careful because there are certain periods, regime shifts where one can move from a lower vol environment to a higher vol environment where these correlations may change. But generally speaking, the VIX and the S&P have a negative correlation of 0.75, roughly 0.8. And as a result, you can benefit from that relationship by in a contango situation by going short front months, short S&P, correct?
And then, that term structure of the curve is predominantly in contango most of the time. I put most in quotes, obviously. But then when the curve flips and inverts and goes into backwardation, then you would be, long VIX, long S&P. I think what's interesting, like you're saying, those correlations is when you're long, you could actually take advantage of a 99 style environment where we had a market melt up while volatility is rising. You would almost get a second tailwind effect kind of from that trade, would you not?
This happens sometimes, yeah. That's a nice scenario, but it's not the original objective of that trade. It's basically like, as you said, a second tailwind where you can benefit from that on top of it. But at the same time, you can have situations, if you travel to the COVID-19 March environment, where this relationship broke down until the 23rd, which was a Monday. It's my father's birthday. That's why I can remember. So from Thursday, Friday, and Monday, the VIX already start to fall while the S&P fell as well. So VIX falling means the uncertainty basically came down because we're coming from really high levels in terms of the VIX index as well as future. And at the same time, the S&P still fell for another 5 days, including the weekend. So sometimes you have these periods where these relationships are not stable. So one has to take a very careful approach when trading that. So it's not just very easy and straightforward. You just put it on and you go on vacation. But it's basically you have to monitor it quite actively. In our case, it actually results in only having a position around 30% of the time. So we're only interested when the relationship is very pronounced, when we refer to the curve and the term structure of the VIX futures is very pronounced and juicy, and there is a lot of earning potential in regards to a manageable risk. If that's not the case, we rather stay at the sidelines. So in 70% of the cases, we don't have that trade on, specifically because there can be environments which are more tricky to manage.
As you said, these relationships are fairly stable, but then sometimes they're not. So every trade has its downside risks. So if you think about if most of the time in a low vol environment, the term structure is in contango and you're short, but then it can flip instantly if you have a VIX spike and you could be on the wrong side of the trade. How do you think about monitoring or managing those risks?
Yeah, it's a very important aspect. And fortunately, data show us that volatility most of the time clusters. So if we, for example, take the environment in February 2018, the Volmageddon, which was the 5th of February. So obviously that would be in a day where you definitely don't want to be short VIX and short S&P, however nice and juicy the term structure may have been prior to that. But however, it wasn't, because volatility announced itself to a certain degree. The curve flipped from contango into backwardation on Friday. And as a result, there were a lot of indications that something larger may happen. And this triggered a position reversal in our case, for example, where we actually took a long position in that intermarket spread. We actually didn't really have a position prior to that. So we didn't have anyone, and then we entered into a long. So it's a function of two things: being very selective about the environment and be aware of the risk of a sudden VIX spike, and at the same time rely on actively monitoring markets and see if they tell you something about what may happen going forward. Obviously, completely out of the blue, things can still happen, and that's why we don't just trade one strategy in that field. That's why we have a second relative value strategy on the VIX side with the calendar spread, which always has two positions on, which can benefit from that. And we combine that with other intraday strategies which have different path dependencies.
Great. I think that hits on the pillar of the intermarket spread. Now tell me, what's a calendar spread on VIX?
The calendar spread basically always has two futures positions on. So the intermarket spread was basically VIX versus S&P, and now in the calendar spread, we basically trade two VIX futures. If you think about the VIX futures with different expiries going forward in time, you can be, for example, long the front months and be short the third months in terms of expiry. And that would be a spread between these two expiries. And the idea here is that you have, first of all, a roll yield between these two expiries. And on top of it, you have also the risk premium again, which you can benefit from. And depending on how pronounced this curve, the curve is, as more attractive it can be to be more active on the front side of the curve or at the back side of the curve. If you think about positioning yourself to benefit from a sudden vol spike, generally speaking, you would like to have a long vol position, as we just discussed in terms of intermarket spread. And that would resonate in being long the front months or being long the second months, again, the third or fourth. But at the same time, because the curve is in contango around 83 or 85% of the time, that would actually cost you money. So being long a front month is resulting in bleed. What can now happen is that you have a situation on the calendar spread side that you can earn something on the backside of the trade in the second or third or fourth, so in the back months basically, earning roll yield to finance, so to say, your long front months position. And as a result, you happen to be well positioned for sudden spikes, which is certainly a much more comfortable position than just being short any kind of expiry in the term structure.
You know, we talk about capital efficiency. So if people aren't familiar with trading futures and intraday trading futures, it provides this capital efficiency or margin usage that maybe people aren't accustomed to, where it adds a nice overlay to the portfolio that doesn't necessarily pull from your cash position. Can you kind of talk about the capital efficiency of trading futures intraday?
Basically, if you buy a future and you hold it overnight, you have margin requirements, and that the margin requirements, generally speaking, intraday are substantially smaller than overnight. In some cases, depending on the setup, you don't even have any margin requirements because your clearing broker doesn't look through what's currently happening on your trading account on the execution side, which shouldn't be the case in a perfect world with everything being controlled. But it's basically how a larger part of the future industry runs. So most of our institutional accounts basically don't really have a look through because we trade all accounts together on an execution side and then give up the trades at the end of the day. And as a result, they have zero margin requirement, theoretically speaking. But for all folks, margin requirements intraday are smaller than overnight. And because we don't really trade most of the time, because we're only looking for larger movements to happen, roughly 4% of the time we are invested, you don't really need capital to allocate these strategies. And we we basically utilize the strengths of these intraday strategies in our entire portfolio concept. If you go back to the four pillars, the calendar spread and the intermarket spread, they may hold positions overnight. The intermarket spread only in 30% of the time, but still. And from a portfolio construction point, if you have 100% capital available and now you allocate, let's say, 70% to one and 30% to the other, you don't have anything left. But if you now apply intraday strategies, you can trade them on top of it. And you can do that because they only engage in specific market environments. They don't require capital to be allocated. You don't have to move capital there in order to have it ready for trading, because they can utilize whatever is sitting in the portfolio in terms of cash already being there, or they don't need any intraday margin at all, depending on the setup. And as a result, you have a very high capital efficiency and can add additional path dependencies to a portfolio without the opportunity cost that you have to de-invest somewhere else or reduce your allocation to another strategy. Yes, we may have entered a new volatility regime with higher volatility. It currently looks like it. It would be beneficial for strategies like ours because we're long vol across the board, so we tend to have a better trading environment, also being reflective in the last couple of months, but we don't know. We don't know if the reality out there with people suffering, high unemployment numbers, geopolitical tensions around the world, if that will catch up with markets who are now trading at all-time highs again in an environment with unforeseen activity of central banks. So as we don't know, and I don't know if my RV Trade 1 or the intermarket spread or the other will actually do a good job, I try to combine as many past dependencies across the entire portfolio. I can't do it all. Guys like you go beyond that point. You have option traders on there as well who are constantly sitting there so that you have a structural advantage as well if something happens completely out of the blue. Because obviously there are certain things we don't cover yet with what we do. We're very comfortable with what we do. We specialize in certain things, but we very clearly support the idea to add even additional past dependencies, being specialized on capturing things we can't capture. And as a result, it makes sense to take a closer look on the long vol space. It is not very easy. You can't get it in very simple products with low fees or something like that, because there's a lot of research and active engagement by managers, despite the fact that their systematic is involved. So yeah, it's a lot of work basically, and you don't have it. It's not as commoditized yet. Yeah, so the rest of the financial world is highly commoditized already, where you can buy and sell market in an ETF by press of a button, but you don't really have that on that side. And the majority of commoditized vol-related products are rather on the short vol side, and these are the ones which blew up again in March. If you think about a German insurance company, which basically sold massive amounts of short vol products to large pension funds also in the US, which basically blew up in March. It's another reflection point where people have a negative connotation when they hear about volatility, VIX and things like that. But it's very often dedicated short vol trades where people are complacent, volatility is low, you can print money by being short vol the entire time until you aren't. And as a result, we have a lot of headwinds in that sense, where we need to go into a dialogue with investors and educate them about the differences in the space, and that selling options is not the same as a lot of other things we do in the vol space.
And that's why I'm always excited to talk to you, because you guys had a very different wrinkle from my perspective of looking at, the volatility space from a very quantitative approach that's very different from other managers that may trade options or other strategies. So as always, I can't thank you enough for sitting down, talking to me and explaining the way you guys look at markets. But I think I'm going to end on one final question. Does Alpha smell like a cool Swiss alpine meadow, or does it smell like a warm Corsican night?
That depends on the regime you're in. It definitely smells good, but most of the time when you smell it, it's not there or it disappears. Thanks for having us, Jason. It's always a pleasure to talk to you. And yes, these things are very complex, but very exciting as well. But at the same time, people are facing difficult realities out there, and we try to help them as good as we can to protect portfolios and add an edge to it, and also at the same time educate these folks. And you and the team of Real Vision are doing a great job in doing so, and we are very honored that we could be part of it today. Thank you for that.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutinyfund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm @TaylorPearsonME, and Jason is @JasonMutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.